Good afternoon, everybody, and welcome to this edition of our Broker Moves Review for Friday, 7th of May. My name is Carl Capolingua. I'm the market analyst over here at Think Markets Australia, and it's a pleasure to be with you as we go over all of the big broker moves for last week. We'll do that, of course, after we talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. Four fantastic reasons why your next ASX share trade should be with Think Markets. And if you are new to the Think Markets family, join us. Before June 30, get trading, and the first 5 trades will be on us, as is the case with all of these things. There are some terms and conditions, so head to the website for more details. As mentioned earlier, today's agenda is to have a look at all the big upgrades, downgrades, price target changes for the big brokers during the week, and also some stocks of interest. At the end, we'll kick off with the upgrades first, and just a little bit of a key as to how these tables work. Each broker has a rating, basically a buy, hold, sell, a recommendation of what their clients should do for the stocks that they cover, and a price target based upon their valuation where they think the price of a share can get to over the next 12 to 18 months. So on screen, we're seeing the ratings changes, and we're seeing ratings improving. For example, Macquarie Bank on CSL going from neutral to outperform, with their price target increasing from $282.50 to $296. Now that's an increase of 4.8%, and based upon the current share price, it leaves about 7.4% upside from the current price to that $296 target. CSL provided the market with a little bit of an update this week, saying that they are well on their way to achieving their plan of opening 25 new plasma collection centres in the US for financial year 21, and they plan to open a further 40 in FY22. Macquarie said also that foot traffic at those centres appears to have risen substantially, and on the back of that, Macquarie had increased their second half and therefore full year 21 earnings forecast, hence the ratings upgrade and price target increase. Flight Centre is having a bit of a tough time at the moment. They announced their March quarter trading update. They said that unfortunately, due to the continued impact of the pandemic, business conditions for them remained extremely subdued, and that there is very little certainty going forward. In fact, at the company's AGM, the CEO said the only thing that is certain is that they will not be reinstating their dividend for FY 2021. Citigroup there saw the positives. They said that they preferred to look through this current downturn out to FY22 and FY23. However, earnings for the company probably won't normalise until 2025. Nonetheless, an upgrade from sell to neutral with a small price target increase there, and still about 14% seen to the upside from Citigroup. On PointsBet, Credit Suisse going from neutral to outperform. It's a small nudge up in the price target, but still about 17.5% seen to the upside there. Credit Suisse said that the company's March quarter results were very impressive. They said that they are the leader in the sports betting market in the US, having more betting markets available on the US Super Bowl than any of their competitors. Things not going so well at ResMed. The company reported a $101 million quarterly loss for the first 3 months of this year, largely because of a $300 million write-down to settle a issue they had with the ATO. They're never very pleasant. ResMed also announced some slowing in the sales of its respirator products as the US started to get more of a handle on the COVID situation over there, and that it was taking longer expected for their sleep treatment products to recover from the pandemic. Despite that, JP Morgan going from lighten to hold, and an increase of about 5% on the price target. Not a whole lot left in it. JP Morgan noted the results were worse than what they were expecting, but said that the overall fundamentals for that sleep market remain strong, hence the upgrade and price target increase. SEEK also had a quarterly trading update out where they bumped up their profit guidance actually from 100 million previously to 150 million. So, a 50% increase on their expectations for full year profits. Broadly well received by brokers, and Macquarie there going from underperform to neutral with a substantial price target increase, some 34%, but that only is really catching up to the share price gains that SEEK has had recently. Having a look at the downgrades, ANZ in the news this week, it reported half-yearly profits were up 45% on the previous half. Obviously, the previous half was depressed due to COVID anyway, so we take those sorts of numbers with a pinch of salt. But they did report some really good progress on their capital ratio. That was up to 12.4%. Their net interest margins improved by a few basis points, as did their provisions for bad debts. Well, basically, they were lower. They also declared a dividend, which was a little bit ahead of market expectations. But brokers were a little bit mixed on this one because the revenue line was a little bit behind expectations. And as a result, brokers were a little bit mixed on it. We've got a couple of downgrades here, but in a couple of slides' time, we'll see some price target increases. Looking down the list, probably the most notable ones there, Coronado from Macquarie Bank. Macquarie noting that the company is still struggling operationally and that coal prices have not risen enough to swing this one back to cash flow positive. So we've seen a 45% decrease in the price target and a downgrade from outperform to neutral. Citigroup on EOS, quite a large price target decline there, 26% buy to neutral. And Citigroup noting major issues around the timing from one of their major customers. Down the list to a 20% increase in the JHC, Japara Healthcare price from JP Morgan, but a downgrade to hold from Accumulate. That's on the back of a takeover for the company. National Australia Bank reported its half-yearly results. Three of the Big Four majors reported half-yearly results this week, ANZ, Westpac and NAB. Generally, the results were very solid. They were quite well received by brokers, but these three downgrades we're seeing on screen are a result of, recent share price appreciation impacting on the valuations. So a small price target decrease there as well from NAB, and with only 2.6% upside here, 2.6% upside here for ANZ and 0.8%. Brokers are starting to feel that some of these majors are fully valued. We've talked about ResMed's woes and that Citigroup downgrade there from buy to neutral. Having a look at the price target increases, no woes at Amcor. They released a March quarterly trading update, which was very, very positive. They said that earnings were up 9%. They also increased their outlook for 2021, now expecting earnings per share growth of 14 to 15%, so tightening the range, which was previously 10 to 14, so tightening and going above it, really. They said that they're benefiting from rising sales as retailers in categories like meat, cheese, sauces, beverages and pet food scramble to meet demand. Brokers liked the results. We saw 4 out of 4 price target increases, albeit small, and fairly limited upside on those. Gives you fairly moot point ratings, but we still have a buy and 8% upside seen from UBS. Looking down the list, Charter Hall announced the acquisition of 25 PFD food services, cold store and distribution centres for $269 million. So brokers just tweaking some of the estimates there. Maybe this is a bit of a standout, isn't it? Big tin can holdings from Morgan Stanley. The broker saying that the third quarter results showed that the company's tracking well. Annual recurring revenue was towards the top end of guidance, and the integration of their recent acquisition of Clearside is progressing well. So 7% bump up in the price target, but 87.5% upside still seen in the stock and an overweight rating. Into the next page, Domain reported quarterly sales as well. They are tracking along very well indeed, as obviously house price activity has exploded over the last 6 months post-pandemic, and they are in the process of negotiating sort of a 6 to 7% increase in prices with real estate agents at the moment, which they expect to be implemented from July 1. So we saw 3 out of 3 price target increases here, but all but Credit Suisse really seeing this one as fully valued, and 3 neutrals on the trot there. Eclipse Group also had some half-yearly results out this time. They said that they had seen a 77% jump in their net profit for the 6 months compared to the previous period, and they were benefiting from higher new car prices. 3 out of 3 broker price target increases there, with actually a fair bit of upside seen in this one, 10, 14 and 23% respectively from Credit Suisse, Macquarie and Morgan Stanley. And with all 3 ratings better than neutral, I'd say that one's probably worth a closer look. Looking down the list there, they're fairly small increases until we get to Janus Henderson Group. Again, another reaction to some quarterly results. And then JP Morgan just tweaking a number there for Chapara after its takeover offer that has been put on the table. National Australia Bank reported its half-year results. They were 35% higher than the previous 6-month period last year, excluding notable items. And the bank doubled its dividend, small tweaks only from brokers, and only Credit Suisse out of those 3 happy to go better than a hold. Nine Entertainment, some good results out from them on advertising revenue from their TV and digital business segments. Modest tweaks in prices, but still plenty of upside seen from Credit Suisse, JP Morgan and Macquarie, and with Outperform, Buy and Outperform, also probably worth taking a closer look at that one as well. Into the next page, let's just keep moving here. QBE, they held their annual general meeting at which they reconfirmed expectations that they will resume their dividend payments for FY21. They also provided a March quarter update where they said premium rate increases were running at about 9% and gross written premiums were about 20% higher than this time a year ago. Brokers liked it. Some fairly good price increases there, some 6 of them. And just Macquarie a bit down on this one with minus 6.1% to the target and a neutral rating, but the rest of them are better than hold, buy, outperform, accumulate and overweight. We've already talked about the SEEK numbers there, 3 out of 3 price target increases, some nice ones, but fully valued at JP Morgan and Macquarie. UBS still sees some value in there with 14.4% upside and a buy. And we'll talk about SEEK later on when we get to our stocks of interest. More third quarter trading updates. The market was rife with them last week here as well, and here. Some modest price target increases there, but some good ones here at 7 West Media, with still plenty of upside seen there, 83.9%, 49%, accumulate and outperform, probably worth a closer look at those. And into the final page, we have the Westpac reaction here to their first half results. They were some 256% higher than the subdued result from 12 months ago. They said that they'll pay a 58-cent interim dividend, compares to NAB's 60 cents and ANZ 70 cents. Generally, it was considered to be ahead of expectations, but the big news actually in that results announcement was their $8 billion cost-out program that they expect to have implemented by FY24. It's a focus stock, so we'll talk a little bit more about that when we get there. Looking at the decreases, we've discussed ANZ, so there were 2 downgrades and 4 price target decreases, albeit very small ones here, and fairly consistent with this theme that that bank at least is fairly fully valued at this point in time. Beach Petroleum, their shocking run continues. They reported a big write-down of their Western Flank reserves, and also that lower production was going to slash revenues going forward. Talking about slashing, price targets down 25% there at Citigroup, 20% at JP Morgan and 17% at Macquarie. I would probably ignore that because the stock's fallen so fast. Some of these upside targets lose a little bit of perspective. But I guess brokers keeping the faith there with Outperform Buy from JP Morgan and Macquarie. Ramsay Healthcare had a trading update. Things were still pretty sluggish for them, hence some small tweaks down in their share prices, but generally a fair bit of upside seen going forward. ResMed we have also talked about. They are still struggling, and some modest price target decreases, but still plenty of upside seen in the share price. QBE, we mentioned earlier on, they have seen an improvement in their pricing ability and in their gross premiums written. The brokers liked it. We saw 6 out of 6 price target increases. Citigroup saying that the results were better than expected. Credit Suisse retained their outperform rating. They said that the improvement in gross written premiums was better than expected, as was the expected losses. So there are fewer claims as people stayed home as a result of COVID. They expect that the improvement will continue. JP Morgan said that the strong performance also will continue and will translate into earnings growth going forward. Macquarie, less enthusiastic. They retained their neutral, but were pleased with the progress on margins and written premiums. They said that tailwinds should continue to help momentum in those areas. Morgan Stanley retained their overweight rating. They said that the insurance industry globally is benefiting from improved pricing conditions and lower than expected claims. They said that the improvement in QBE's fundamentals should continue, and UBS retained their buy rating. They said that improving pricing power is moderating. So actually, even though they've got that buy rating, taking a less positive view about some of the metrics there, but they said that overall earnings would continue to improve through FY21 and FY22. Gives us an average of a buy at the moment with 3 strong buys, 6 buys, 2 holds, no sells, no strong sells. That's always a big positive for me. You know, they say the beauty is in the eye of the beholder, and none of the beholders thought that QBE was particularly terrible. That's encouraging. The fundamental numbers here, and if you tuned in during the week to my fundamental analysis refresher, you will be an expert on how to read these digits. Enterprise value to revenue is outstanding. Typically anything sort of below 3 there is good. The PE ratio is high, but there's some growth in this business right now, actually. As you can see, the PEG ratio is very low and far less than the target of 1, and allowing the PE to fall from FY21 to FY22. The yield is very good, and it's going to get better. Price to free cash flow is very impressive. Return on equity, however, is disappointing, but not totally inconsistent with an insurance stock. I'm going to give that a very solid B+. That's obviously a big tick here, and the chart actually doesn't look too bad. Yes, there is still a long-term downtrend in place, but it is moderating. You can see it switched from this pink area to orange, and we have seen that we have gone from sort of being resisted by this zone to potentially being supported by the zone, and this is the furthest we've been away from it to the upside. The short-term trend has swung to up. I like the look of the candles here. They're predominantly white. I wouldn't be surprised if it pulled back to this short-term uptrend zone, probably around the low 10s, but I think you could probably buy it there actually, based upon the fundamentals and the brokers. So, something like that with a nice price action signal in here. So, yeah, I'm happy to call that a buy, contingent on the technicals panning out the way I'd want them to. Next stock we're looking at is Seek. They upgraded their profit guidance. JP Morgan retained their hold. They said they were pleased with the trading update and the profit guidance upgrade. They said that the Australian Asian businesses were performing well. Macquarie, they had the upgrade there from underperform to neutral. They also raised their price target a hefty amount there, 23.60 to 31.60. They liked the profit guidance increase. They said that both volumes and pricing are set to continue to drive earnings growth, and that further upgrades are probably likely. UBS, they retained their buy rating, a fairly decent price target increase here, or at least I should draw the arrow that way. The broker said that there's some pretty strong data out at the moment on the jobs market in Australia, and that should support the business going forward, and that the upgrade actually wasn't surprising to them. Well done, UBS. But they did note that the upturn is cyclical. All that means is that at some stage it'll probably moderate. We've got an average of a hold at the moment from the brokers. Strong buy, 1, 3 buys, 6 holds, and 1 sell. So that's a little unnerving there, but not a deal breaker. Looking at the numbers, enterprise value to revenue, that's too high for me. The PE is way too high for me, and the growth isn't sufficient to justify that PE. The dividend yield is not fantastic. That's not bad, and that is negative. I'm probably recovering from COVID. I might refrain from giving that one a rating, but I think you can guess what it would be. It wouldn't be very good. I'm going to go cross here. The chart actually doesn't look too bad. I mean, we're in a well-established uptrend. I don't like the fact we've broken below this short-term trend. It does mean we're probably going to come back to here and test that, and I might look at it in there. So it's a pass for me at this stage. Having a look at our final focus stock, it's Westpac. Brokers, they like the results actually. Probably out of the 3, this one was the best received. But the biggest point of focus was without a doubt this cost out program that they announced, $8 billion. that should be implemented by FY24. I'll let you press pause because it's basically all about that cost out, the comments. But we did see 5 out of 5 price target increases. And when you compare that to the mixed results we saw earlier on, there it is there from ANZ and NAB. Clearly this is the pick of the bunch. Look, that's evidence in the average of a buy rating there. 2 strong buys, 6 buys, 3 holds. That's curious for me. I wonder if they just haven't updated their ratings for a long time. Looking at the numbers, that's not fantastic, but not surprising given it's a bank. The PE is not great given what bank PEs typically are, but there appears to be some growth in the business at this stage. The dividend yield, as always with these banks, is outstanding. Price to free cash flow is excellent, and we don't have those because they're probably negative, still coming out of COVID there, and maybe the FYs are going to be better. Look, I can't give you a really good idea on that because it's only partial. That I'll give it a tick. I'll give this one a tick here. The chart looks fantastic. Well-established uptrend, well-established short-term uptrend. The price action looks good. The candles look good, predominantly white. Yes, there's a little bit of supply coming in at the previous all-time high, and we probably didn't think somewhere around here we were going to be saying that so soon, but this one looks very constructive. If I had it, I'd definitely hold it. If I didn't have it, I'm happy to maybe get a few before the dividend if I'm a yield-focused investor. Well, that's it for me today. Thanks for joining me, of course. You can catch all of our other market news updates in our market news section of the website. If you like, you can follow me or the Think Markets handles on Twitter. You can also head to our webinars page and register for our upcoming events. Ask the Experts. That'll be on Tuesday next week, where you get to bring your portfolio to the table. Ask me about any of the stocks you're interested in, and I'll give you a quick technical and fundamental. The week after that, we've got our top 3 series continuing with top 3 ASX stocks under 30 cents, and then another technical analysis lesson there using price action to spot trading signals. The disclaimer before I leave you says that the content of this presentation is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So if you have any doubts or concerns or any questions, please read this disclaimer carefully or give us a call. It's been a pleasure chatting with you this afternoon. All the best for your trading until we catch up again. Bye-bye for now.